I was lucky enough to purchase a Sydney unit in 2011, just purely from luck. How do you outperform other investors? Now here's the big question. What separates a good investor from a great investor? Hey guys, people always ask me, Jai, how do you spot deals that no one else sees? And what really separates a good investor from a great one? Well, the truth is, most people walk past opportunities every single day. There are properties, there are great deals out there. Most people just don't have the eyes trained and experience to see them. Today, I'm going to share with you exactly how I approach my deals, what I look for in properties, and the difference being good at investing and being great. When I first started investing in property, I was in my 20s. I had no idea what I was doing. I didn't come from money. But what I did have was a hunger to learn, and I took action quickly when others hesitated. I made mistakes and learned from them to become a better investor, because no one's perfect, no one has all the knowledge that they have in the beginning. So I did use buyer's agents to help me along my journey. But later on, I use it as a learning tool to help myself buy properties using my own method. Today, I've built up over $14 million in my property portfolio, and I didn't get there by being perfect. I saw opportunities, I learnt, and I thought differently about risk. One of the biggest mistakes I see investors make is focusing on the wrong things. They stress about interest rates. Is the property value going to go up or down? Is it blue chip or not? Do they follow the herd into hot spots that everyone else is talking about? But that's not where the best deals are. The best deals are usually where other people aren't even looking. So let me break down exactly how I approach finding those opportunities. Number one, and the most important thing, I believe, is understanding the property cycle and market timing. You see, a lot of people will say time in the market is more important, but I actually disagree, because if you buy at the wrong time, you may see stagnant growth for years, or possibly even a declining market. I'll give you some examples of my personal experiences. And this is how I really started to learn about market timings. So Sydney started booming from 2011 to about 2016, and then it started declining for about 2017 to 2020. So it didn't go up in a straight line. Brisbane and Perth were also flat for around 10 years from 2011 to 2021. So if you purchased during this period, you would have saw little growth for a whole decade. So sometimes investing is a bit of luck. I was lucky enough to purchase a Sydney unit in 2011, just purely from luck. Ride the growth, and I was able to release equity to purchase a second property. I bought the unit for $428,000 in 2011, and then the valuation came back around $700,000 after a few years. However, in 2023, I only sold it for $560,000 because the market actually went down. That's why timing in the market is so important. Another perspective is my Brisbane property, where I purchased this in 2016, which I personally believe was around 5 years a bit too early before the market actually moved. Because of this, I couldn't actually get any equity out of the property for around 5 years. Right, so if that was my first property, I would have been stuck for 5 years. So my purchases after that have been pretty well timed, because I understood the market cycles and how timings work. So I bought 4 properties in Queensland within 2020 alone, because I saw that the market hadn't grown for a long time, but other areas were growing, and the yields were also increasing, which means it's only a matter of time before capital growth starts to follow. And then in 2021, Queensland started to boom. Another example that I saw off the back of this is Western Australia. I then went in 2020 to 2021 pretty aggressively before other investors went in. Same as Victoria last year. Before other investors were jumping on, I was going in facing less competition as compared to right now, right? Because I saw opportunity in those markets. Number 2 is looking beyond the price and what value potential there is. Can this property be renovated? Can it be subdivided? Can the floor plan be adjusted to add another room or bathroom? My recent purchase in Geelong is around 700 square meters on a corner block, and I can put a second dwelling on the backyard after a subdivision to build another house to double the rental income and get equity in future as well. Number 3 is use debt as a tool. I get it. A lot of investors are scared of debt, but if you use it strategically, right, property is a game of finance. Use a range of major banks, tier 2 banks and tier 3 banks to help you increase your borrowing capacity to get the funding to buy the asset. right? The key is to making sure that the cash flow is good and that you can structure it correctly. Number 4, do the opposite what other people are doing. Have you ever heard your friend talking about investing in a suburb? Because if you have, that's probably a bit too late. Because if everyone's chasing one suburb, that suburb is usually already overpriced. I personally would rather buying in a second ring area where there haven't been that much growth, because there will be less competition. And that's where usually the growth will be, like the domino effect. Number 5, triple check your figures and don't always trust statistics. Get on the ground feedback. I don't just buy a deal assuming everything's going to go perfect. I run scenarios. What if the interest rates go up? What if they go down? What if rents drop? What if the property sits a little bit too vacant for longer than you expect? I'll double check what the current properties on the market are actually renting for, and I'll also check what they actually sold for in the current month. I'll call up agents, speak to property managers, and ask for on-the-ground feedback, because stats may not always give you a true picture. Now here's the big question. What separates a good investor from a great investor? And how do you outperform other investors? A good investor can find a solid deal. They'll buy in a decent area, get some growth, maybe some cash flow, and they'll do well, right? There's nothing wrong with that. But as investors, we want to be a great investor. We want to outperform. Great investors anticipate shifts before they happen. They don't just react to the market. They position themselves ahead of the market, and that's where you can buy in areas before other investors. Think of it this way. A good investor plays checkers, but a great investor plays chess. And here's the other thing. Great investors build systems. It's not just about one property. It's about stacking multiple properties in a way that compounds over time, because that's what's going to help you get a growth and compounding portfolio. It's about thinking long-term, building resilience, and also scaling strategically, knowing when to buy and knowing potentially when to sell. If you can build a solid system and process, it makes every acquisition easier after that. And if you want to go from good to great, here's what I'd recommend. Build yourself a checklist of non-negotiables for every deal. It could be things like maximum price, maximum vacancy rate that you'll accept, the minimum rental income to make this deal stack up, what's the maximum renovation spend that I'm going to put into the property. Have your finances ready so you can move fast. Don't wait to pull equity out when you buy. I see this mistake all the time. Have the equity ready before you even need to buy, so you can actually jump on opportunities fast, because money likes speed. Because ultimately, being a great investor isn't about luck. It's about preparation, perspective, and execution. So the next time you look at a property, ask yourself, what am I seeing that others might be missing? That mindset alone will put you miles ahead. That's the difference between a good investor and a great one. See you guys in the next video.